Hello, and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir, and I'm joined as always by David Broomfield. David, for this week's episode, I gather your subject of choice is inspired by a recent holiday.
Hi, Sarah. Hello, everybody. It is inspired by a recent holiday. So I was in Norway last week.
Nice.
And Norway's just, I've been going there for decades now, once a year. And every time I go, I'm always shocked by just the standard of living, the level of infrastructure. And it got me thinking about the Norwegian Sovereign Wealth Fund.
Yeah, fascinating.
Yeah, so I thought let's do a little piece on sovereign wealth funds. And what's amazing, I think, is just how understudied they are, and given how big they are. So let's talk a bit about that, I think.
Okay, good. But before we get to that, I wanted to pick up with you something we talked about on a previous episode. I think it was back in May. We talked about AI and what was needed to be in place before AI could reach its full potential, because there's a lot of excitement about AI and how it's going to change the world. But we had a really good discussion about, but there's going to be some things that are going to need to happen first. And I think we saw maybe different stories this week, but I saw a piece about Sam Altman and his involvement in Helion energy and nuclear fusion. There's a little bit of skepticism maybe about the feasibility of the kind of nuclear energy that is required to make AI really take off and go into the stratosphere.
Yeah, I'm. You know my views on. I mean, everyone should listen to that podcast. I mean, I think I made the remark that nuclear fusion is only ever 10 years away, isn't it?
Yes, and it has been for about 50 years.
You'll have to forgive my skepticism that someone has cracked it and brought it, the commercial application to market. But the point, I suppose, is that everyone is recognizing the opportunity here, the opportunity that data centers, AI, and just our general connected life is presenting across the ecosystem. So, Helion is one company, but, you've got other companies a little bit more grounded in the physics of today, which are looking at making very small nuclear fission, so nuclear reactors, as we know, in that sort of 1 to 2 megawatt range. And that technology has been around since, the 60s, really. I mean, it's kind of like the designs that are put on nuclear submarines. They're a little bit different. They use different coolants. They use molten metal, not pressurized water, but it's essentially the same idea. And it brings the cost down to 80 to 130 bucks a megawatt hour. So that's similar price to gas at peak demand and wind at peak demand. So, when we talked about data centers and how just hungry they are for power, I think two things. I think, demand is met with supply, but also we had some great feedback from a couple of people who are in the industry in different parts of the ecosystem with respect to AI, talking a lot about how AI itself is going to optimize grid demand and the balancing of the grid. So I think you've got, I'm now, having reflected on that podcast, I'm very much now of the view that the opportunity of AI is actually not at the retail end. It's not at the front end. It's probably behind the scenes. It's probably optimizing all of those things that make our everyday life work. I think that's probably the opportunity, infrastructure.
Because I actually rather facetiously said that can't the data centers use AI to optimize energy use? And it seems like that actually, maybe I wasn't being so stupid after all. Interesting. But it's interesting because I think, there's certainly a lot of skepticism about what can be achieved, because I think this particular company that Sam Altman's involved with, they're promising to be able to deliver nuclear fusion by 2028, which, as you say, it's been 10 years away since, I don't know, the 1960s probably. So
and many investors have lost their fortunes backing the next nuclear fusion idea, or even cold fusion, which is even further into the realms of science fiction. It's in the lab. Obviously progress is being made, but bringing it online commercially at scale is a whole different matter. And to Sam Altman's credit, as an investor, he's adopting a key principle. He's diversifying his bets here. So that micro fission company I mentioned that's miniaturizing nuclear reactors, he also is chairman of one of those. Right. He's investing in a lot of these energy startups. I think you can take that general view on energy demand and infrastructure without necessarily backing an individual company to to revolutionize the world. Who knows? Maybe it will happen.
Yeah. Okay. Well, I'm sure we'll be coming back to this topic again, but we are going to talk about sovereign wealth funds because you were busy living in the wilderness in Norway, catching fish with your bare hands and all that sort of thing. So how are we going to divide sovereign wealth funds into 3 sort of topics?
I'll just gloss over that. I'm not going to take the bait, if you'll excuse the pun. But we could do a whole podcast on an area of Norway that's very close to my heart, Hardangervidda, and the history of it. But I think we'll probably disenfranchise 99% of our listeners. So let's talk about sovereign wealth funds. I think the interesting thing, as I said, it's really understudied. It's amazingly understudied as an area. So let's try and bring it to life. Let's talk about who they are, how they invest, and what their performance has been like. Given their scale, I think the second thing to talk about is their impact on markets, the economy, the good things, the bad things that come from investing at that kind of scale. And then I think the third point, which is which I think is quite interesting, it's relevant to our investment process at Coutts, is the sort of ethical considerations of investing for the long term as well.
Yeah, because certainly the Norwegian one, that was why it was started, wasn't it, in the first place?
Exactly, and it's had a very clear mandate. But not all the wealth funds, as we'll see, subscribe to a stringent set of criteria. Some are much more murky, let's say.
Should we say less transparent?
That's a much better way of putting it.
Yeah, okay. All right then. So when did the first sovereign wealth fund appear? Who were the big ones? Because I read somewhere that there's something like 176 sovereign wealth funds around the world.
Wow,
but some of them are quite small, aren't they?
Some of them are very small. So the first one, I believe, was in the early 50s, and it was the Kuwaiti Investment Authority. And it's interesting that many of the sovereign wealth funds have their genesis in managing revenues associated with resource extraction, so oil. And, if anyone that studied economics will be acutely aware of the resource curse, of Dutch disease, of, the effect of selling a commodity priced in dollars and the vast swings that can have on your inflation or on your exchange rate. It's very problematic. And I think to some extent, sovereign wealth funds were set up initially, at least, to kind of smooth that effect of a volatile commodity. I mean, obviously, some of them have grown to absolutely gargantuan proportions now, and they've taken on a whole different role in economies. So Kuwait, I believe, was the first in 53. And yes, I mean, there are hundreds of them, but let's just look at the top 10, shall we? I mean, if you go through the top 10, 5 of them are from Asia, 4 are from the Middle East, and 1 in Europe. And no prizes to guess which the one in Europe is. It's the world's biggest one. It's the Norway Government Pension Fund, and that's about $1.6 trillion. It's utterly enormous.
Crikey.
And even China Investment Corporation at 1.35 trillion is not small by any means. The Kuwaiti Investment Authority that I mentioned, just shy of $1 trillion, at around 923 billion. And there's some fantastic data from the Sovereign Wealth Fund Institute. There's an institute for everything, Sarah. You just have to dig it out. And they calculate that as of 2023, collectively, all these sovereign wealth funds deploy about 10 trillion in assets into capital markets, both public and private.
That's a phenomenal amount of money. Is all this money going into equity markets?
It's a really good question. So I thought let's look at a couple of them, and we can sort of compare and contrast. I mean, generally they adopt a mix of passive and active management. And okay, yes, the active ostensibly is pure alpha seeking above passive, but actually it fulfills a slightly different purpose in some of the wealth funds. It allows them to direct capital in the national interest. And let's talk a little bit about that in a bit. I think there's such a growing influence in financial markets. Anyone out there that's got Bloomberg will know this. You just have to look at the top holders of any security, and it's the same names in there, in the sort of top 3 or top 5 holders. And it's 2 or 3 of the biggest sovereign wealth funds. I mean, if you take the case of sort of Norway's sovereign wealth fund, you're looking at about 9,000 individual investments. And so, when you're 1.63 trillion, your big challenge is not to start owning companies outright, because you've got so much capital to deploy. So let's look a bit. I thought we'd look at Norway's, maybe dip into Singapore's and a couple of others. So Norway, set up to shield the economy from the ups and downs of oil revenue, as I mentioned. And it's very much, I suppose, globally the hallmark for transparency and openness when it comes to. So it's the easiest portfolio I found to interrogate.
Yeah. I was looking through today because we talked about the fact that I know they have a lot of property holdings, and I wanted to check whether they still hold big chunks of Savile Row, and they do. Lots of property in London, in fact, around Regent Street, around Mayfair, Savile Row, and all around the world, basically. But anyway, yeah.
No, well, that's both a feature and I think one of the. We'll talk a little bit about that when we talk about the impact on markets and the potential risks, because it's been one of the areas. Real estate has been one of the areas that many people have highlighted as potentially a concentrated asset class in sovereign wealth funds, and that has its own set of risks. I mean, I really enjoyed going through the 9,000. Why I didn't go through 9,000 companies, but I just scanned the list. There's some great ones in there. You've got the world's largest cannabis company in there. You've got plenty of what I thought was interesting is there's plenty of what are colloquially termed as panda bonds, so Chinese bonds issued in local currency in yuan, not US dollars. I mean, on China, I actually contrasted it with the Chinese sovereign wealth fund. They are very active investing in Hollywood. They love movies, and they pretty much own legendary entertainment, which brought you such hits as Jurassic World and The Dark Knight. I mean, so it's really interesting. Some of these sovereign wealth funds not only are these sort of giant anodyne investment vehicles, they like to delve into private markets and very niche investments. So focusing on Norway, it's a global fund, and essentially it's a 70% equities, 30% bonds portfolio. And they really limit the deviation from the benchmark quite closely by about 1.25%. So it's very, very close. And you think, well, okay, that doesn't give you much room to make very active bets. But when you break down the portfolio, the majority of that's in listed markets, but they do put about 9% thereabouts in unlisted, and that covers things like property or infrastructure type investments. So they're going with that 70-30 portfolio. They want to do 3 to 4% annualized. That's their target. And if you go back and look at how did it perform from January 98 to the end of 23, it's pretty good. They've done an annualized rate of return of just over 6%. Okay, I mean, recently it's slightly underperformed, but that's a story of how one particular sector, technology in the US, has just ripped ahead. But over that longer period, which is what they're interested in, it's done pretty well.
They did report a loss, though, didn't they, recently? Because of I guess it says something about the size of the fund, that there was an error in an Excel table where they had the wrong date for, was it US fixed overweight? They were marginally overweight US fixed income. And as a result, because of a mistake in the date that was entered into the Excel, they lost $92 million or something. I mean, that's a drop in the ocean, I suppose, for a fund the size of the Norwegian fund.
Yeah, I mean, there's a whole, listeners out there might be amazed at how many Excel errors have crept into, so native Excel errors have crept into businesses and industries, particularly it's a real problem in chemistry and physics and where you have these giant data sets and you find there's mathematical errors in the Excel code. But in this case, I believe it was human error. Look, I mean, if you're 1.6 trillion, 93 million is a drop in the ocean, but it just shows you they're not immune to mistakes or losses like any business. Go on.
I was going to ask you, so who decides what they invest in? Because you said there's a bit of passive, there's a bit of active. Is there sort of an investment committee, and do they kind of review performance on a quarterly or annual basis so that they make decisions and make shifts in asset allocation?
Yeah, they do. It's quite strictly controlled because so it's basically outsourced to Norges Bank as the investment manager. I mean, the Norwegian Ministry of Finance sets the framework, and bear in mind its purpose, its objective is to transfer wealth to future generations. But the government, and this is one of the key points about sort of openness and transparency of these funds, it's the extent to which governments can actually dip into the till and access them. And in Norway, it's very strictly controlled. So the government can access it under strict guidelines. It can make withdrawals that are limited to the expected real return, which is 3% annually. So the government can use it to finance budget deficits, because one of the roles of sovereign wealth funds is to basically stabilize the financial system and smooth the kind of the economic cycle, meaning that governments don't have to take on excessive borrowing, but they can only dip into, in the case of Norway, into the fund under these very tight tolerances with full public oversight. So it's not, so it's outsourced to effectively an investment manager to run, and its annual reports are published. Like any fund, it's got reams of governance that allow you to interrogate the portfolio, and the portfolio itself is published as one giant data set. And then the mechanisms that allow money in and out of it are all in the public domain as well, all controlled by the Norwegian government, effectively.
We talked on a previous episode, and I don't have the date to hand, about industrial policy. How much of sovereign wealth funds are part of that, where you've got sort of state intervention in the domestic economy? Presumably they could be used for that as well.
Yeah, they are. And let's come on to that a bit when we talk about the impact of them, because that's one of the key points, I think. And right, while we're on the topic of sort of comparing and contrasting, so we've talked a bit about Norway's sovereign wealth fund. 70-30 bonds, equities performed very well.
Super transparent. You can go on their website, and I easily spent half an hour going through all their property holdings. So yeah, it's all there for public scrutiny.
It's great. And putting that side by side, I suppose the next nearest, I think, equivalent is probably Singapore and GIC, very similar to Norway. It has a slightly different emphasis on sustainability. It's a little bit different to Norway's emphasis on sustainability. It's very focused on emerging markets in the local region, as well as being a global investor. I think what's interesting about the Singapore portfolio is just how early they've been as an investor in technology and certain technology companies, and how concentrated it is in technology. And then finally, I won't dwell on it too long. If you look at some of the Middle Eastern sovereign wealth funds, take the Abu Dhabi Investment Authority as an example. In contrast to Norway, much less transparent. It's invested globally with the aims to build a diversified, long-term focused portfolio. It's got slightly more focus on probably private equity and infrastructure than the other two, but the benchmark's not clearly stated. And then if you break down the portfolio, there seems to be quite wide tolerances between individual sub-asset classes. So they really vary massively in what you can interrogate from a portfolio point of view and a performance point of view. Norway and Singapore stand out quite clearly, I think, as the most open and transparent.
Okay, so remind me of the size of the Norwegian fund. The number's so huge, I can't remember it.
Yeah, exactly. Should we not quibble about two decimal places? Let's call it 1.6 trillion.
Okay.
What's 300 billion amongst friends?
Yeah, exactly. It's an Excel accounting error, isn't it? Let's face it.
Exactly.
All right then. So we've talked a lot about Norway. Massive fund. They're investing in, we've just, as you mentioned with Norway, they own something like 1.5% of all shares in the world's listed companies. They've got something like 9,000 companies they hold within their fund. That sounds like that could have quite an impact on global markets, especially if they decide at some point, do you know what, we don't want to hold that anymore. It's quite a sizable chunk if they decide to exit a region or exit a company holding.
Yeah, exactly. This is the second point. This is the markets and the economic impact of sovereign wealth funds. So the markets impact, you're quite right. There's two elements at play here. So the first element, I think, is about stabilization. Okay, and that is sovereign wealth funds playing a role in capital markets to act as a kind of, I'm going to say, investor of last resort. Is that the right way to phrase this? So if you go back and look at, the 2008 financial crisis, you'll see, various sovereign wealth funds investing in banks. Those that have been around a while will remember that, sovereign wealth funds recapitalized a number of banks. China recapitalized its own banks with its own sovereign wealth fund, but then you have, of course, had the Abu Dhabi Investment Authority taking a stake in Barclays, along with Qatar as well. They, generally, well, in the case of that deal, they took convertible notes and warrants, which then later converted into equity. And it was, in a crisis, it was incredibly not only useful, critical to have a source of dry powder to stabilize the system. Away from crises, you've had more speculative investing. So I mentioned that the GIC, the Singapore Sovereign Wealth Fund, is very keen on technology. They were very early in Airbnb, Alibaba, Impossible Foods, names like that. And you also have it working the other way as well, and being, like you said, quite sensitive to geopolitical risks, particularly if nation to nation is a slightly different calculus when it comes to geopolitics. And some of the sovereign wealth funds more recently have started to flex their muscle and say, no, these are geopolitical risks that we're no longer willing to entertain, which I think is quite interesting. But your point was about the impact on individual names, like a sentiment-driven impact, and that's really important. And generally, like if you look at North American equity, like on the S&P 500, okay, it's a very deep liquid market, so the sovereign wealth funds trading there is less problematic. But there is evidence, I looked through the academic research, and particularly in emerging markets and certain parts of the bond market, there's evidence that sovereign wealth funds can cause quite significant capital flows. Now, some of that is just sentiment, people following sovereign wealth funds almost driving it. But also some of it is just the effect of them just being such a big trader, such a big player in a particular market. They're having an effect on volatility and an effect on spreads. So those interventions I mentioned in the 2008 financial crisis, they did cause big volatility. They did achieve their intended and stated aim of recapitalizing the banks and stabilizing the system. But if you were facing the market at that point, there were some huge intraday moves as these funds started to deploy capital.
Isn't it also the case that actually the US government got a little bit concerned about some of this sort of foreign investment in their banks, and they passed, what was it, the Foreign Investment and National Security Act, that allowed sort of greater scrutiny, I guess, of foreign government or government-owned entities trying to buy US assets as a result of that?
Well, of course, yes. And as I said, I now feel like I've been around a while, because I remember in 2007, CIC, so China's investment company, taking a $3 billion stake in Blackstone, which is very US focused. It's a private equity firm, very US focused. And, that was heralded, I think, as, it shifted perceptions of China's investments in the US, okay? Both positive initially, but then obviously what's grown since then is, again, in line with geopolitics, people are now looking quite closely at ownership of companies, and particularly in strategically sensitive sectors, where they're, obviously in the military industrial complex, there have always been sort of regulations around those sectors. But now in technology, given how critical it is, as we found out last week with the blue screen of death appearing in airport terminals all over the world, that these sectors now are very, very critical.
Yeah. And then because I talked about property, because I mentioned the fact that particularly the Norwegian fund has big ownership of London property in conjunction with Crown Estates and Pollen Estates. How much has that skewed then? Well, let's take Norway and London perhaps as an example. How much has that skewed property markets, that involvement?
Wow, that's a huge question. It's one I don't know the answer to. It's one for Kitty O'Shea, our resident London
who's coming up on an episode soon. Yeah,
maybe we can ask her. The interesting thing, though, is the IMF. So I said this is a very understudied area. Some of the big consulting firms have looked at this. The IMF have looked at sovereign wealth funds. And one of the areas the IMF highlight is in a handful of global cities, there is a very high concentration of sovereign wealth funds investing in the same sort of hyper prime real estate. And the IMF notes in London how concentrated that is. Difficult, again, to get figures. A lot of these are anecdotal or estimated, but it's clear that they own quite large chunks of various capitals. So one for Kitty, I reckon.
Okay, all right. Well, she's coming up soon, because we're going to be talking about the next Coutts London Prime Property Index. So I'll ask her that. Okay, so then what about, because I sort of jumped ahead a little bit and talked about sort of industrial policy. How does that play in then with these sovereign wealth funds? I mean, what role do they play in sort of state intervention? We talked about foreign markets, but what about their own markets?
Yeah, so they many of them have a focus on their domestic market, particularly in the private equity space, to promote various businesses that are either of social importance or national importance. I found a few studies on this, which I thought were quite interesting, and it shows that actually, when sovereign wealth funds take big stakes in some of these private companies, these acquisitions can actually have a positive, significant impact on the competitor firms, not on the firm that they take. And there's lots of reasons why they think that might be. Increased sort of perception of stability and confidence in a particular sector. That when a sovereign wealth fund takes, like, let's say in biotech or a small sector, if a sovereign wealth fund takes a big stake in a particular company, it can attract wider investment attention to a particular sector and bring, as I said, sort of increased stability, increased certainty of capital flows. And the competitors around that firm that a sovereign wealth fund might take a stake in can benefit from, when sovereign wealth funds take an investment, they quite often improve governance and oversight and transparency in a whole sector. So there are kind of these externalities, these positive effects that ripple away from just the company that they invest in. So there's definitely some positive effects locally and positive effects on sectors by deploying that amount of capital. And obviously, this has moved the dial immeasurably when it comes to sustainable investing. I mean, sovereign wealth funds have influenced corporate behavior on sustainability, on ethics. They've have, I suppose it's all counterweighted with this risk where if you don't have that transparency and that openness and that architecture, then obviously the political motivations of investing could come to the fore. And I think that's what's key here. It's about having that independent oversight and having that clear sort of investment process and guidelines.
We certainly can't classify all sovereign wealth funds the same. Some are more transparent than others. Some have slightly different rationales for existing, and some are commodity and non-commodity based. But yeah, what did you want to say, David?
Well, I'll give you an example. So, I talked about Singapore investing in technology sectors, and they've favoured some very local firms as well. But if you look at China as an example, China has pretty much bankrolled most of the Belt and Road Initiative from their sovereign wealth fund. So, that's something that is strategically important to China. So it's less about the short-term investment case. It's more about a kind of political, geopolitical aim in a strategically important sector. And I think that's the point here. They can have huge impact over the medium term in that respect.
So I guess they're not necessarily all about generating returns, are they? They might be about, or not generating returns over the next 5 years. They might be generating returns over the next 10, 20 years.
Exactly. And, remember why they were set up. They were set up not just as, not just to transfer wealth to future generations and make money. They were also set up to kind of stabilize the economy and stabilize the system. So I mentioned sort of some of the market effects, and they're about deploying large amounts of capital, the effects on liquidity, the effects on sentiment within sectors, those things I just discussed. But the pure economic effect is quite interesting, that they do tend to have an effect on stabilizing the exchange rate of when a country has a sovereign wealth fund. They do tend to have a stabilizing effect on the exchange rate. And also, it goes without saying that they can help governments manage deficits and surpluses, and that boom bust cycle that many of those commodity exporters have experienced, certainly in the latter half of the 20th century.
Is that why they have that stabilizing effect on the currency then? Because the economy is deemed to be less susceptible to boom and bust, because they know that the sovereign wealth fund could step in and smooth things out if required?
Yeah, you have to do some econometrics, and you look at the effect of the sovereign wealth fund once you strip out all of the other factors, things like monetary policy and the labour market. And this effect is especially true for those commodity-rich countries who end up importing a lot of inflation, right? As you know, as the price of their commodity rises or the dollar rises, you end up basically importing inflation, especially if you're pegged to the US dollar. So, by having a sovereign wealth fund, the money is often held in US dollars, so it doesn't bid up the local currency in the same way. So that it's interesting, isn't it? How that was almost how they were set up. That was their original mandate, and what's evolved from that is this much more. I'm not going to say lofty ideal, but this idea of a much more multi-generational transfer of wealth mandate, which has appeared in the last sort of 20 years. And that aligns with what's going on in demography as well.
Yeah. Okay. Well, let's come then to this your final point then, which is about sustainability, ESG. How good are sovereign wealth funds? Because it was my understanding that partly the reason for the Norwegian fund being set up in the first place was they recognised that they were getting a massive amount of revenue from a fossil fuel and felt the need to offset that by having a fund that would, to some degree, kind of focus on sustainable issues, ESG issues. I mean, long before it became a buzzword. But it's how good are sovereign wealth funds at doing that? The ones that we can obviously monitor, the ones that are transparent.
So going back to the data from the Sovereign Wealth Fund Institute, you can get a rough idea that about 50% of sovereign wealth funds. Okay, there's quite a few, and I don't know to the extent to which that number applies to the bulk of the capital, but 50% of sovereign wealth funds have adopted some kind of formal ESG policy. Norway's clearly the leader. I think that's been the theme that's run through this whole podcast. It's been the leader in integrating ESG. So it is very clearly divested from companies that do not meet its ethical guidelines, which are published and you can see. So examples there, similar to our own investment process, like thermal coal extraction and overt environmental destruction are banned. So they're actually divesting. They're not even trying to influence into the companies. Contrast with Qatar, they've pledged openly to align their investment strategy with the UN Sustainable Development Goals. So, everyone is moving in that direction because, irrespective of your moral ethical view on any of these particular companies or sectors or issues, there's a capital markets imperative to do this because you can see that growth stocks that are aligned to being the recipients of money associated with the climate transition. So your fusion example or microfusion reactors, these are stocks which at that end of the spectrum should benefit from the amount of public money that is about to be spent on climate transition. So it makes sense to favor these through an investment process. And then at the other end of the scale, you've got companies that are let's just say they're dirty companies today because they operate in a particular sector that's perhaps carbon intensive, but they have the potential to change their business models to be more sustainable, and then they get a sort of brown to green re-rating effect. So, as I said, just try and separate the moral and political imperative to do this from the fundamental investment case of doing this, and that's what I think these sovereign wealth funds are starting to navigate. It's tricky because it is it's public money. So as you want to try and create a stable investment framework that is immune from political influence as the political cycle changes, which it will over the decades to come. I think what's interesting, I mentioned Singapore, they've got a focus on local businesses and supporting local sustainable businesses. They write that into the terms. And the other one I found that I thought was interesting was the Azerbaijan state oil funds. I think that's SOFAs, it's called. They invest quite a lot of money into historical and cultural heritage. So, sites in Azerbaijan that are of historical and cultural interest, they effectively fund and turn into heritage sites. So, it's not just geopolitically driven investment, to try and create some some advantage or some leg up in a nation's competition with another nation. It's also very domestically focused, trying to plow back excess returns into preserving either the environment or cultural heritage. I think some of them have got some quite great examples of impacts they've had at a very grassroots level.
That's not necessarily going to generate much revenue for them, is it?
Probably not. But I think what seems to be a common theme throughout all of them is there is a tolerance about taking excess returns and ploughing them back into local infrastructure, local communities, or the local economy, but making sure you maintain the overall value of the real value of the fund in question. I mean, if it's if you take Norway as an example, 1.6 trillion today, you just have to sort of run the clock forward another decade, and these funds become huge. I mean, there is it wasn't one of my 3 points, but there is a debate going on in policy circles at the moment of whether some of these funds should be split into multiple funds.
Too big.
With slightly different mandates. And a little bit of that is driven from just the simple investment problem of deploying that much capital and not owning companies and causing spikes in volatility, etc. But also, I think people are realizing that you can perhaps have more targeted investment mandates. But nothing's changing today.
Okay, well that's been really interesting. So we talked about sovereign wealth funds, how long they've been in business, and certainly the first one you said was in 1953. The size and importance of them. We talk about the Norwegian fund, which is the largest one at give or take $1.6 trillion. The impact that they can have on markets, and also perhaps a force for good in the impact that they can have on stabilizing their own economy, preserving natural resources of their domestic economy, and also from an ESG point of view, where they can choose to actually deploy that capital for a positive influence on economies and on sectors. Well, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you very much, David. Thank you for listening. Make sure you never miss an episode by subscribing to Need to Know. You'll find previous episodes, including the one that we talked about on today's episode, AI Needs a Smart Grid, where we talked about what's needed to make AI actually really reach its full potential. That the discussion around nuclear fusion was just one of those things. And also last week's episode, when we were joined by Howard Sparks, and we looked at different investing styles and the pros and cons and the challenges of different investing styles. We'll be back next week with more Need to Know. Until then, bye for now.